So good evening and hi to everyone. So welcome to this webinar, which is organized in cooperation between NGI Tetra and NGI Explorers. Today's webinar is on optimizing your access to capital, building FOMO, and understanding the fundraising process. So today we will be talking about, for example, investor personas and the fundraising roadmap. And I will do a quick introduction to Will, who is the speaker today in a second. Let's see if my slides also want to change. Perfect. But before we start with the webinar, I just wanted to say a couple of words about Tetra and what we do. So I think many of you have been in touch with us in one way or another, maybe through our bootcamp or some other webinars. But just as a reminder, Tetra is one of the NGI projects, and we are one of the, let's say, support projects. Our goal is to support all of the projects, companies, startups, researchers, and so forth that have been funded under the NGI. So, and we do this in various ways. We provide training, for example, through webinars such as this one. You can access mentors through us for those who have gone through our boot camps. We organize boot camps. That's one form that we do trainings. And we also support in building networks. So through us, you can get access to your local support organizations, for example. So just to sort of exemplify, what are some of the things that are coming up? So you can always check them out on our website. And so some of the next events that are happening after the current event on October 5th, we have a webinar in collaboration with NGI Zero and NGI Pointer, which is about the smart use of intellectual property in the next generation internet. So very thorough and interesting webinar happening on IP. On October 8th, we have a webinar on visibility and growth hacking. Then on October 19th, this is a very long title, but it's a webinar on critical thinking, creativity, collaboration, and communication. And this is also in collaboration with NGI Explorers. And on October 27th, then from lab, how to get to the lab, from the lab to the market, and how to generate revenue. So how to find your customers and get your go-to-market strategy off the ground. So those are just four that are currently also on our website. One of them is going on up on the website very soon, but there are many, many more events such as this one planned already. So keep an eye out. And if you're interested, you can always ask me and write to me, and I can share information with you directly as well. One final thing I wanted to mention, some of you were also part of our Build Up Bootcamp this summer. And I'm happy to let you know that we have a follow-up to this bootcamp. The prerequisite to come to this one in November that's happening is not that you have been to the previous one, but everyone who was a part of the summer bootcamp is welcome to apply to the Scale Up Bootcamp happening on November 23rd to 25th. It will also be online due to the fact that the COVID situation is not getting that much better. And it will comprise of a number of webinars and workshops. You'll get training on IP, equity funding, marketing, sales, pitching, and much more. And everyone who applies will get and is accepted will get an individual master plan and work with mentors and coaches. So all of the topics there will be then focused on a later stage than they were in the summer bootcamp, and a bit more sort of growth oriented. Again, more information will be coming up to our website. Let me check. I think Eva is not with us yet. So I just want to mention that I'm very happy that today we're working together with NGI Explorers, and there will be many more events coming together with NGI Explorers, and hopefully we will see all of you there as well. And now then I can get to why we're here today, the most important part, which is to talk about fundraising. And to do that, we have Will Cardwell. Will is an angel investor in VC. He's also a professor for University of North Carolina, Aalto University, and Helsinki Business School. So giving lectures there on similar topics that he's going to talk about today. And today we're focusing on the fundraising process. As such, we'll give you sort of an overview and a few tips and tricks of, here and there, how to sort of define what type of investor you want to work with, if the investor route is the one that you want to take as well. And I'm really happy, Will, that you're with us today. The final thing that I just want to say is that we have a couple of slots of one-on-one mentoring also with Will, and I will give you information about it later over email. But without further ado, Will, I will give the floor over to you. You're muted right now.
There we go. Now we got it. Okay.
Yes, absolutely. Perfect.
Okay, great. So really good to see you guys here, and really looking forward to this session. Give me just a sec. So am I a presenter? So can I share my screen? I think I need you, Greta, to let me do that.
Try now.
Okay. Yes. All right. Now everybody disappears. Okay. Interesting. All right. So as said, my name's Will, and I am I've been doing trainings like this in a lot of different capacities over the years. But today I'm going to talk to you about kind of understanding the fundraising process, and at the end I say kind of the title is Optimating Your Access to Capital, Building FOMO, and Understanding the Fundraising Process. So I looked at a number of you. It turned, I think 3 of you had already raised capital, at least in the larger list, and it looked like almost half of you were planning to do that at some time in the reasonably near future. So I think this will be, I'm trying to make this relevant to you guys, but to all of you who are kind of undecided, what I hope to be able to do is give you an understanding of how to think about this fundraising process, and a little bit how to, like I said, build FOMO, make investors fall in love with you, and really just have to have shares in your company. That's kind of the way to think of it. About me, so I've been a partner in 6 venture capital funds over the years. I've led 56, at least 50, probably more like 60 investments in mostly in very early stage companies similar to yours. Kind of investment sizes have been anything from an individual of a few tens of thousands of euros up to several million in the first case, or kind of in the first tranche, and then up to 10 million over time. I've been in the venture capital system here in Europe, I think, but specifically in Finland since 1999, so long time, 21 years, seen in a way 3 cycles now. So I saw the original Web 2.0 or Web 1.0 .com kind of bust in 2000. I saw the financial crisis in 2008. And now, of course, we're in whatever we are with the COVID crisis, which is kind of a weird one, obviously, because the markets are up, the valuations of companies are way up, yet the economies are struggling, and of course, a huge amount of uncertainty. So very interesting environment right now. I have a team in my current fund. We have 10 members. We invest in digital health for the most part. And I'm just lucky to have a wonderful team. but I really want, the way I define myself is by the entrepreneurs I've invested in. So this is a kind of a cross section, and the thing I love about them is actually I looked every single company I've invested in recently over the last 3 or 4 years, which is about 40. Every single one of them is diverse in some way. Immigrants, women. Mostly actually teams that are kind of very diverse, and that's something I really concretely believe in, that, and really something that most investors look at now. The teams are not just, like me, one older white guy, but really a team that's more diverse, both age, experience, country, and I think programs like this are really useful in helping to build out that type of a team. Great to see the list of people here being from so many different countries, and from so many different disciplines. All right, so purpose of the session. So I want to keep a tight view on time. So it's 1/4 after. So I'll aim to be done, or I will be done by 6:30 finish time or 5:30 CET. I want to start with motivating how to fundraise, which you'll see my angle on that in a moment. I want you to understand a little bit about the investor mindset. So what is it that the investors are really looking for? What do they value about you and your company? And it's not as obvious as you might think, at least in my opinion. Then a little bit about the material that you would need to prepare if you've got to go out there. And then I'm going to share after this a folder with some resources. And one of them is something I use called the fundraising workshop, or fundraising workbook, which is basically just a Google Doc with a number of tabs that can be useful for you in kind of drilling down to the type of investor you're looking for, setting up kind of a CRM or a kind of a tracking system for how your process is going and stuff like that. So I think there are 4 components, and I will start, and then just, here's kind of very high level. I think it's important to have the right mindset. It's important to define your targets, how much money you need to raise, how much, how long it is before you get that money, or before you need the money. Does it come from an angel investor? Does it come from a corporate investor? Does it come from a grant giving organizations? Here, I'm talking mostly about equity investments. So people that are investing, put money to the company in return for shares. But I think one important thing, being most of you being scientific innovators, most of the grants across the EU are dependent on you having a certain, let's say private sector grants are depending on you having a sufficiently strong balance sheet, and many of them actually depend on you having an active investor on your cap table. So defining the targets for your fundraising, meeting the right people, super fundamental. I'll talk about that in a minute. How do you use the right tools? Preparing the digital and physical materials. So you have to do presentations, both digitally, physically, by email, sending a deck somewhere or one pager. And then of course, doing a lot of hybrid stuff now. And then a little bit about the pitch. That's not really my strongest point. But many others that talk about pitching strategies. I'll say a little bit about it, but that's not what I'll dig in too much here. All right, so first thing, actually, I'm going to have to reshare because I want to do a quick, about a 4-minute video that I think is fundamentally changed the way that I view fundraising. And so I'm going to reshare because I want to share with the right audio settings. So give me just a second. Optimize share sound. Now it's in there. All right. So I'm going to show you a short clip that's from Stanford University by a guy named Peter Diamandis, who formed the X Prize Foundation, Singularity University, some other things. I have to say, this guy is when I saw this video, like I said, it really changed my perspective on thinking about fundraising. Now, subsequently, in the COVID age, actually, Peter's become pretty controversial, but I'm not going to kind of go into that. So sometimes people will point out that he caused some pretty big problems in the U.S. in the first half of the year by kind of having some big events when COVID was still too wild at that point. But that doesn't take any away from the fact that this, I think, is a very interesting video. But I just didn't want to kind of come through here saying I really condone his approach. So what I want to do is show you this, and then what I'd like you to do is think a little bit about it as you watch it, and then I'd just like a short discussion or a couple comments on kind of what you learned from this. Now, setting the stage, so Peter is flanked, has a venture capitalist right next to him who's going to come in later in the presentation. So keep that in mind when he's talking, that there's actually going to be a kind of a venture capital point of view later in the talk. But I'm going to stop. I'm going to start the video, and then I want to make sure that the audio is sharing okay. So I'll stop very quickly and just ask, and if somebody can just say, maybe Greta, if you could just say if the audio is working right after I tell you. So hold on just a minute.
The question was about fundraising and the lessons learned from fundraising, because it was such a...
Greta, did that work?
Yeah, I can hear the audio.
Okay, great. All right, so I'm going to play this, and it's going to take about 3.5 minutes, but it's actually, think about it, reflect on it, and we'll talk about it in a moment.
An integral part of X Prize and everything you did.
So
the question was about fundraising and the lessons learned from fundraising, because it was such an integral part of X Prize and everything you did.
So it is probably one of the most critical skills that you can learn. I think of fundraising as energy transfer. It's going to someone and convincing them to give you some energy that you can go use to go and accomplish something. And I had a formative moment in my life, my sophomore year at MIT. I had started my first organization ever. It's called SEDS, Students with Exploration and Development of Space. And it's, become a global student space organization. And I'd started the first chapter at MIT, and I needed $5,000 to print a newsletter and mail it out. And I went to Draper Labs, and I met with the head of Draper, and I knew they were profitable. They were nonprofit. They had money, and I was pitching them my heart out. Would you please? I need just $5,000. And he says, "I'm sorry, we're a nonprofit. We can't opt to give money. What you're doing is great, but..." So I was walking out the door, and I stopped, and I said, "Well, could you instead print my newsletters?" She said, "Sure, we got a whole printing facility here." I said, "Would you mail them?" He said, "Absolutely." We probably got about $25,000 worth of printing and mailing from Draper over the years, that year and the following years. And it hit me that there is, whenever you go and you ask something, first of all, you have to ask. I mean, the first rule of sales is you have to ask. You have to believe in yourself and what you're doing passionately enough that you're willing to give this person the opportunity to help you or to be involved. And then you have to ask. And then you have to commit to yourself, I'm not going to walk away from having invested that time without something. It may simply be, why aren't you investing? What advice do you have for me to go and on my next call? Who can you introduce me to that does want to do this? And I think other thing I learned, a sage fellow, Al Kurth, taught me in my early days X Prize. He said, when you ask for money, you'll get advice. And when you ask for advice, you might get money. And that stuck with me a long time. So I used to be extraordinarily impatient. Hello, what's your name? Could you give me some money, please? And I learned that that's not necessarily the best way. People, when people invest in you or in your project, they're investing in you. It's a transfer of confidence. So you really need to build a relationship with that person. in a way that you touch their heart, they understand why you care about this, how it relates to them, and then they will naturally want to get involved. But I can't emphasize enough how important that is in a skill. If you want to go and do something, it's about convincing other people to join you, bring their technology, bring their money, have George invest in your company.
Yeah, it's amazingly true, because we see it with entrepreneurs. Some of the best entrepreneurs, in the fundraising process, the fundraising is secondary to wanting to get groups of people involved. They don't show up and say, the calculation of how much money you're going to make is 4.7x over 3 years. They don't do that. And a lot of people ask me and other venture people, how do you decide to fund something? What is the critical amount, what are the critical internal rate of return? I'm like, there is none. And some people say, well, how can there be none? I was like, well, we like to think, can we return 10 times the invested capital? But the reason why we say 10 times is really because the way we qualified in our heads is, can this generate a sufficient breakout that we're proud of our association, and it could also make money. But 10x is really just a qualifier. It's not really mathematical in the sense, and that always puzzles people, but it's actually the truth. You've said it the best out of anyone I've ever heard.
Thank you.
Okay. Again, I find that really interesting. But let me ask if somebody would mind contributing here. In particular, any of you that have either raised money, meaning in particular equity funding, or are planning to. Any comments, or does this resonate to you? His message here.
Yeah, we are planning.
Yes.
Somebody else?
No, please, Alexander. It looks great. It looks like you've got an expert a consultant there with you.
Oh yeah. Yes, I was involved in many ICOs and producing white papers in the blockchain domain.
Oh.
And actually, Draper was a major investor also. So I had people from his academy doing startups coming to me.
Yep.
And so that was for me. So I'm a professor at Tallinn University of Technology.
Okay.
So for me, this was primarily at the time in 2016 and 17 and parts of 2018 for doing action design science, because there was no funding otherwise in the blockchain scene. So I thought, okay, I pose as an entrepreneur. And then I was approached and they said, okay, could you write this white paper? And for me, that sounded like, okay, it's like a technical report.
Yeah.
And the first one I did was Qtum, if you know that, qtum.org. Maybe
Yep.
I can.
Yeah.
Can I type it? Yeah, you know it. Yes.
I know. Yeah, absolutely. Wow.
And so I wrote the white paper for the ICO, and that raised some 30 million.
Wow.
30 million, and I almost fell off my chair. And then I published this. I rewrote it and published it in a scholarly peer-reviewed way in Springer.
Yeah.
And of course, since my name was on there, I then was bombarded from all sorts of startups, some dubious. It turned out, sadly, some very good. Yeah, because it's sad. I mean, you win and lose. It was a very mixed bag. Just like during the first .com phase.
Yep.
And I never. I mean, it went mostly super well with the fundraising and then republishing. And I was accused that way to have helped to raise some $75 million.
Wow.
Which, So
that's
that's kind of
so
what I did.
That's amazing. I think you kind of, one of the things that comes out there, I mean, you really captured a wave. Your timing was perfect. You got out there before anybody else did. I think the white paper example is really, really interesting because, I think investors are fascinated by scientists that can write something that actually they can almost understand. And obviously blockchain is a huge trend. So So interesting. There's again, to the FOMO thing, huge amount of fear of missing out on the next big thing in the blockchain space. But,
and that died out a little bit, so the importance of white papers has kind of collapsed.
yeah.
But never mind. I mean, I still published all the scholarly papers, so even if then the team maybe was not so good and they bummed out, the papers are still there, so it can always be picked up, by a more competent team. Maybe anyone can download those papers from Spring or IEEE or whatever, and give it another try. So the papers are all very valid, and Qtum has pretty much taken off.
Yeah,
I think they have now a market, what cap or so, as it's called, of 1.2 billion.
and again, I think that again you find a trend. I mean, you were on the front end of a trend, and I think one of the all the things as you guys are working on different areas, figuring out what is the trend that the wave you're riding that will kind of get investors believing that you can tap into a large market. So thanks a lot for that, Alexander. Good, interesting comments. Anybody else? Yeah, please, Serena.
Yes, Serena, it's fine. So I have experience from three different perspectives of fundraising. I'm Albanian, and I've worked in Albania for roughly 4 or 5 years in the humanitarian and for-profit sector, where I was a fundraising officer for organizations like Caritas or other organizations who wanted to raise funding from US Embassy there or international foundations. And then I've worked with a startup as a consultant on an equity-based agreement where I've helped the last 3 years raise almost $5 million, non-dilutive, and among those just a little bit in a convertible loan. And then recently, and that's why I'm here, I'm raising funding for my PhD, which is not necessarily very traditional research, but action research, trying to have a final product out of my PhD project. And I'm not the best research there. I'm actually more of a practitioner like that. But one thing I've noticed on all these 3 experiences as supporting to raise funding, definitely this transfer of confidence has always been present. And it has to go both ways, right? So the team that is seeking for funding might have certain insecurities that you have to overcome with your pitch, with your track record, with ways of how you plan to mitigate the risks. And then there are many other insecurities that the funding body or the VC in front of you have, but won't ever admit. So you have to navigate their insecurities as well and see, okay, how can I reassure them that they're going to be in the spotlight, they're going to get what they want. And if it's not money, it's going to be visibility. If it's not that, it's going to be knowledge. So that was actually one of my strongest points when I was advising the co-founding team of the startup, that as you have to do the same due diligence on the VCs that we are discussing as they're doing on us, right? Because they'll see it as a sign of confidence in our team, but also a sign of confidence that if we want to work together, we want to know everything there is to know that can influence this collaboration. And I noticed that it was completely the same, no matter if it's VC, if it's European funding. We went through some major interviews for 2.3 million euros last year. And the same with humanitarian organizations who come with an agenda from their originating funding body. So that's a little bit on my. So
I really like that. I like everything you said there. It's one of the things you highlighted. It's really in the reason I showed this slide, this video is, whether you're getting bank loan, whether you're getting a grant, whether you're getting VC, whether you get an angel, there's certain things that are always there. And that the way I kind of summarize it is, you talked about it's a selling process. It's really about sales. And so you got to think, what is it that these guys want to buy? And sometimes, like an investor is buying, obviously, growth, rate of return, but generally they're also buying other things. And they're buying, the kind of joy of being associated with a project, whatever, changing the world, whatever. And so I think that always thinking about the sales and ask, making an ask is important. Always getting something out of every meeting, whether it's because you're going to get no's, but the efficiency, and we'll talk about efficiency in a minute of the process. But fast no's are golden in this area. The worst thing is a slow maybe that ends up being a no, where you've wasted all this time and investment. So I always think about that. I'm investing my time in this, so what am I going to get out of it? Get some know-how, get some links to maybe another investor, whatever. Absolutely if you ask for money, you're going to get advice in general. I find that all the time. But the asking for advice, trying to kind of onboard them or get them kind of part of the movement that you're doing. That's the goal. So in the beginning, you're often, I find that the ask is just, another meeting, another discussion, a chance to do a demo, chance to, collaborate on something that may lead eventually to some sort of an investment. Whereas, if you just go in and say, I'm raising, the typical thing, I'm raising $10 million or $5 million, and I value this project at 20 million. Generally they're going to say thanks, but no thanks, it's over. So it's better to kind of bring that along. And I'm going to talk about getting people involved. The last thing he said that I'm going to address in another section is actually the rate of return that investors expect. And what Peter, I think it's George said about 10 times, generally think about 10 times money back. That's true. An angel or a venture capitalist wants at least 10 times their money back. So if they're going to invest $1 million, they want 10 million back sometime in the future, generally in the next 3, 5, 7 years. So obviously, by asking that kind of rate of return, they're expecting you to grow quickly. But to his point, nobody comes in. When I go in the first time I meet an entrepreneur, I'm not even thinking at all about how many times of my money I'm going to get back. I'm trying to think, do I want to actually spend time and work with this person? Is there a path to me understanding this business well enough that I can help and bring something to the team? So Sharon, you hit a lot of great points, and I have to say one of my actually most successful investments is an Albanian professor, Banja Apgarian is his name. He's at Northwestern University. He's really one of the world's leading chronic pain researchers. We've spun out his research into a company that has kind of a mobile chronic pain clinic, and it's really, really exciting.
Yeah,
So,
if I can, well, I'm based in Denmark actually, and I'll be in Chapel Hill next week. Part of my collaboration, it's UNC and Renzi Institute, so we could organize a meeting as soon as I travel there next week.
I'm based in Helsinki, though. That's the funny thing. So I was. We missed each other. I was in Chapel Hill for the last year, or about a year ago, but when COVID hit, I moved back to Finland. So.
Okay, but the last thing I just wanted to throw out is that I saw a startup in Sweden that really intrigued me with an idea of making venture capitalists pay 2,000 euros for sharing the slide deck. So if you would like us to share the concept with you, and that was mostly for Series A and further in that process, like higher, larger amounts. He said, well, you want the slide deck, you want a meeting, you have to pay a fee of 2,000 euros because you're getting knowledge with it. So I'm just bringing it out here. Maybe it works for some, depending on how the co-founding character is. But
so I think you're getting to the important thing there is that if you've built a couple companies and you have kind of a reputation that you can do this, then you can name your price basically. And I think that's an interesting approach. But we'll move forward a little bit because I want to make sure I get to all my stuff shortly. I mean, fundraising, a lot of people perceive it as it is a black art in a way. but it has kind of, there's more science, art, philosophy, in my opinion, than math, science, or finance involved in the actual fundraising process. Because definitely at the end, we're going to talk some about the math, but that's the tail wagging the dog. The dog is, can we figure out a way to get through to the investor, kind of an optimal investor who's willing to actually invest in the company. So I say this a little bit facetiously, but this is a typical process of raising funds with a venture capitalist or an angel. And that's, there are multiple meetings. Ultimately, you get to a negotiation and closing time where you basically do a bunch of negotiations around shareholders agreements, investments agreements. We're not going to dig into that here. You'll have to get a due diligence done on you, meaning the investor will probably bring either, they may do it themselves, or they may bring in auditor or lawyer, whatever, to do that, and then eventually funds released. This process, typically from the beginning of a angel or venture capital funding round to when they make the first meeting with the first investor, to actually getting the money into their account, people like to say the average is around 9 months, 6 to 12 months. But that actually is a little bit of a misnomer, because a lot of the fundraising rounds end up with no money being raised. So if it's a successful round, it'll be 6 to 12 months. Unsuccessful round will never even raise the money. So I think it's the way I like to think about this is first of all, like I said, it's efficiency. If you think about it just in this linear process, any one investor follows more or less this linear process, but can you set up a fundraising process that will handle many investors coming in, interviewing a number of them, having discussions, having them moving at different phases to maximize, kind of optimize the amount of money you bring in and the speed that you get the money? That's where the art is. And that's where I find that linear thinking is not perfect. Fortunately, there's a nice tool for that. And I'm knocking off totally something that's used in the, all the lean startup things. So the business model canvas. So some of you may have seen it, and my gut feeling is or something similar. However, to Peter's point, a fundraising process is really a selling process, and there's a business model behind it. So I like to think of the fundraising model canvas in this way, that we have investors segments we have to figure out. We have offer a proposition to those investors. We've got to find channels to get through them, and we've got to get and then we got to manage the relationship when we get there. So to me, it looks like this. You think about what are the benefits that you provide over your competition to that investor. Super important is that your competition is not necessarily, if you're building a scientific measurement device, your competition isn't necessarily, especially in the investment world, it's not against other people doing similar things to what you're doing, or similar devices or whatever. Your competition is with everybody who's going to those investors to raise money. So you've got to think about it a little bit differently than when you're doing your kind of, like Greta was talking about, you work on your go-to-market strategy and your value proposition. That's super important, fundamental to everything. But here, when I think about the value proposition to the investor, I'm thinking about, again, what does that investor want, and what can I bring that no other startup company or no other university spin out or whatever is going to bring. So that's kind of that. And then, you have to think about which segments of investors you're going to kind of focus on. Is it angel investors? Angel investors are individuals who invest from their own pocket, their own balance sheet. Super angels are obviously just kind of, a typical angel will invest. Actually, in Finland, it's interesting. In Finland, the average angel invests about 20,000 euros for a ticket, and they're part of a syndicate up to 10 investors that typically invests about 200,000. So a very standard kind of angel investment size will be 200,000 to 300,000 and have anywhere from 2 to 5 or 6 or 7 individuals taking part. But a super angel is, of course, you know, typically much larger, somebody that can invest millions. And there are not so many in Europe as there are in the US, but they're growing. And I'm going to give you an example in a minute. Then you've got venture capitalists. That's an institutional investor that invests other people's money. So when I'm investing, typically I'm investing mostly other people's money. And my success as a venture capitalist comes if I invest in your company. You do really well, you either do an initial public offering someday or you do a trade sale, and I receive many times my money back. I pass most of it back to the investors, but I keep a little piece. So that's the venture capitalist business model. Then there are corporate investors. Obviously, there's crowdfunding, which is super, you know, growing trend. So there are a number of different platforms in Europe that you can raise equity capital on kind of a crowd platforms. I've got a couple examples later on, and then others. So there are a number of segments, and you need to think about what's the segment for me, what's the one that you know, I think will resonate. And usually it will be several, right? You're, of course, you know, often people are all pitching to angels, super angels, and VCs. And, you know, typically, and so that's so, but you got to kind of understand that. You also understand you have to think about very early, and we're going to talk about this more in a moment, how much money do you need? So that's a loaded question. And when I say that, I mean that really you may need a certain amount now, but you'll probably need more later. So isn't it, when you think about that question of how much money do you need, think about your milestones in your project. So, and how many milestones ahead do you want to fund now? So maybe, you know, if the first you want to, you've got a, you know, maybe you've got a patent or you've got some code base or, you know, some research you want to package up into a product. Think about, you know, the stages of developing that product and getting it to market. And generally what an investor wants to see is you kind of try to raise at least 12 months worth of capital. So don't try to raise just enough money for 3 or 4 months, but because then you'll just be raising money all the time. Try to raise enough money for 6 to 12 months, or sorry, 12 to 18 months, I think. But the other number you should think about is how much money will you need to raise over time before you are profitable and growing, which is an impossible question to answer, right? I mean, you know, this is usually entrepreneurs get really frustrated when you get this kind of question because there's so many futures out there and we don't know which one's going to happen. But the point to this is, as an investor, I want to know what your plan is so I can figure out, am I aligned with that plan? And so that's kind of the two pieces of this. How much do you want to raise now? How much do you need over time? Then you need to think about how do you get your message through the first time? Do you do through online events? Do you submit your profile to angel platforms, SBAN in Estonia or FIBAN in Finland? All the, you know, most of the European countries have their own business angel networks. And then there's the kind of federated European business angel networks. Then a lot of EU organizations, EIF, you know, EIT, others have sponsored kind of angel networks. So can you, what is it you do to get your message through to, you know, as many potential investors as possible? And then of course, as soon as you get them, how do you retain the momentum? So this is a very kind of a typical, again, this is kind of a, it's effectively just a knockoff of the so-called business model canvas. But I think that this, to me, is a better way to think about fundraising than just think a bunch of linear processes like this. How can you set up a process that will allow you to get to a conclusion? All right, so I'm going to give an example now, and this is somebody mentioned Draper, and it was here as well. Alexander mentioned Draper, so this is going to come up in this case. So I used to run tech transfer at Aalto University, And one of the first projects that we funded inside the university and then decided to spin out, this is 2011, we started, and I think I've got to do this, and I've got to do something here a little different. Just give me a second. Where's my, I have to go here because I need to drag something. So I'm going to do it like this. Sorry, it's a little small, but so basically we decided it was actually a web application back in 2011 that was it was a new form of a discover or kind of a search engine discovery, content discovery engine that was browserless. They'd done a good prototype, and we had, I think, funded it with maybe 190,000 euro grant. And so we went out and started talking to local investors here in Finland in 2011, 10 years ago. And the only investor we could get interested in Finland was a very well-known angel investor, actually a Nokia multimillionaire. So he'd done very well in Nokia in the late 90s, was investing a lot. He gave us an oral commitment to invest 50,000 euros. And he invested it at a, he suggested that he would own 20%. So the question here is, so this is the math test. So if he's going to invest 50,000 euros and he's going to own, after the investment, 20%, what's the value of the company? What's the valuation of the company? Anybody want to take a crack at that? I know you guys are used to like crazy math stuff, and this is not a very difficult math problem, but anybody want to throw out a number? I heard something.
Is it pre-money valuation or a post-money?
Thank you. Good question. So that shows something. So I'm going to ask for post-money. You want to guess, or you want to say what it is?
There is a guess in the chat.
Oh, there is. Okay, sorry. Let me say, yes, thank you. Okay, 250 post-money. Yes. So, and then, okay, so this kind of spoils the surprise, but so this is basic venture capital math, and really, it's all fairly basic, but the idea is that the post-money valuation with the money in the bank is 250,000, and then pre-money valuation is really it's simple mathematics. So you just subtract off the 50,000, and what this says is kind of the intrinsic value of this project was about 200,000. Now the funny thing, the thing I really want to so I'm going to ask good question, Alan. I'm going to so what I'm going to, the way I'm going to kind of answer that is that the pre-money is the amount that it's worth a split second before the money hits the account, right? So the nuance here is you could argue that actually this company is worth zero before the money comes in. If with no money, you can't develop the project, right? So it's, but at the same time, it's kind of rests on the fact that you're certain that the money's coming in. If you're certain you're going to get the 50,000, and it's just a matter of waiting till the money hits the account. For that split second, it's kind of worth that 200,000. So that's the first part. I'm going to get to Jonathan's question in just a second. A point about the, or actually no, the post money valuation is actually Alan's question. So, but let's look at investor B. So we got this offer, and we were kind of, like I said, we had put 190 or 180, 190,000 as a grant as a university, and we, in return for that, we got some equity in the startup. So we said, well, okay, this guy says it's worth, we put in 190,000, and now it's worth 200,000, right? So the added value was kind of 10,000. It's not a lot for 2.5 years of hard work by some really super smart people. So we decided to go out and start actually go to an event, a program that we had with Stanford, or was at Berkeley at the time, but the founders, scientists and the researcher and the entrepreneur went together to Silicon Valley. They pitched to an investor. Actually, is a Draper group. Draper Fisher hosted them in a pitch, which is one of the major Valley VCs. And they didn't. So the VC decided not to invest. It was too early, but they knew of a super angel who was looking for a project like this. They referred it. They went to have a meeting. It's actually a Danish investor based in the U.S. He, in one meeting, agreed to put €1 million for 20%. So this guy, the Finn was willing to put 50,000 for 20%. This Dane, who was based in the Valley, was willing to put $1 million for 20%. So that makes just to make this move faster. I won't kind of do any guesswork here, but post-money valuation is basically €1 million divided by 0.2 or 5 million. Pre-money is 5 minus 1 or 4 million. So the exact same business plan, the exact same demos, same guy, same everything. 3 weeks later was all of a sudden went from 200,000 to 4 million worth of kind of intrinsic value. This deal closed in a matter of weeks. So we actually raised that money and raised another $1 million from that investor, and kind of a fascinating story after that. But my main point here is that, this drives entrepreneurs crazy that it's not about what you've done. I mean, it's partially about what you've done, right? But it's also about what is the audience that you're able to pitch to Serena's point, and maybe others, Alexander said a little bit about this. Can you go out there and find the investor that has an idea how big this market is? The primary difference between these two guys, they were both wealthy guys. This guy was the B is a billionaire, the A is 100 millionaire. So I don't know the distinction there. It's kind of, but one's an order of magnitude richer. That has something to do with it. But my argument is that actually the investor B was very knowledgeable about this market, and he'd actually built and sold a company that was kind of in a related space, and he had a big vision about how big this market could be. So he was willing to think about a $1 billion exit or a $500 million exit and incorporate that into his math, where this guy did not have that background and he saw a smaller market. So he it probably couldn't afford to put $1 million into individual company. That's true. But on the other hand, he also just did not see the scale of the market. And that's why it's so important to be able to position your project in a market that's very sizable. All right, let me talk a little bit more about the investor's brain, because again, this is where I'm fascinated. I've been a student of this for 20 years and published a little bit around it, but kind of lived it and died it by investing. But this is a nice graphic. I think it was a master's project at Stanford that examined really one of the global leaders in investing, Tim Draper, who's his father, I guess, started Draper Labs. I think Bill Draper, but this guy has a great reputation as he's certainly the early blockchain, but early in many other things. And this undersells how many investments he's made. He's made many hundreds. But the point is, every investor has a way of kind of an algorithm for looking at the value and what kind of companies they want to invest in. So let me start this way. This is a typical way that investors think about their interesting. Really, Crossy, great. So tell Tim hello if you see him. I was a Draper, gosh, that was like 8 or 9 years ago. What a crazy place.
Yeah.
Cool. So how long are you there?
I'm there for almost a month until the 23rd of October.
Awesome.
I'll make sure to say hi if I see him around.
Please,
Haven't seen him so far.
He does show up. Funny enough.
Yeah.
but now you're going to understand his brain. So basically this is kind of the way he looks at his portfolio. So down here you have the superstars. So just 9 superstars. Then you have a bunch of companies that have kind of succeeded. They've done pretty well, but they're not, so-called unicorns or whatever. Then there are a number of kind of messy question marks. They might make it someday, they might not, and then a bunch of failures. So all this experience has created, a neural network in his head that says, okay, I match patterns based on this. So my pattern is Tim Draper. I first want to know, is the market big? This is not, by the way, these are definitely, investors have all kinds of different paths through this. His first check, is this a market? Are they addressing a big market? Are they going for $1 billion market? So if that's true, then, and he believes that, then he goes through, okay, is this a place where you can make big margins? Mainly, is the competition limited in such a way that you can charge a really good price? Dump anything where there aren't really high margin players. Then is the team awesome? Now there's definitely a large, and I would probably argue the majority of investors will say their team first. So it's first about the team, then everything else. But for him, you find that these big investors, they believe they're narcissistic, definitely, and they believe they can make a company great. So if they get a great idea, they care about the team at the end, but in the beginning, as they say, well, am I learning something here? If this team isn't capable of doing it, I'll figure out a way to get a team and do it myself. Something you should always be cognizant of as an entrepreneur is to make sure that you don't share too much. You got to share a lot early on, honestly. But if you've really got some secret sauce, obviously if there's a patent issues, but even in certain trade secrets, make sure you handle those with care. But at the same time, you need to be forthcoming and basically kind of get through that screen. So he goes from a team, then find people smarter than you. Can you grab a big market share? Meaning, again, is there is a competition such that we can really excel and build a big market share? Do you have partners? So is there a credibility factor that's brought in by collaborators or people that you're working with that they know? So can you kind of get him some validation that you're really on the front end of your business? Then at the end, he kind of makes a designation. Are you potentially number 1 or number 2 in this big market? And then eventually, if you get through all these screens, you get the investment. So so again, oversimplified, but it's worth kind of keeping in mind that every different investor has a different algorithm that gets through kind of the similar things. I'm going to highlight. So here's Tim, these guys. Raphael was a student of mine in 2011. They built something called ISI, which is a nano satellite platform for imaging, satellite imaging, and just superstars. They ultimately got to Tim, even just when they had a very early on in their idea. So that was another spin out we did from Alto. They were able to get to Tim, they invested, and then they were rated the most successful or the most innovative company in the whole Draper portfolio of hundreds of companies in 2017. And now I think they've raised almost 700 or 800 million euros, about 2/3 of it is equity, and then some huge EU grants as well. So I wanted, that's kind of these were the most unassuming guys, and in the class, they were not, nobody would have guessed that this team was going to do that kind of huge, massive success. So we always kind of, it's a marvel at the, how actually students can put together brilliant ideas, even, whether they're kind of more basic or whether they're quite scientific like this, and ultimately get to great investors. So that's kind of the kind of path to greatness, if you want to put it that way. Fundraising value proposition to the investor, I just want to highlight here. This is where design thinking comes in. I think when you're thinking about investors, you're trying to think of things from their perspective. And it's very, I always kind of distinguish between empathy and sympathy. I'm not sympathetic to investors. There's no reason to be sympathetic to them, but you have to be empathetic in the sense that you have to understand what their issues and how they're thinking about things. And then if you can then build an argument for them based on what you know to be true about the way they look at the world, you can really, you've got a great shot at raising a significant investment. The last one in this session, I want to talk about the lead investor. So this is the fundamental. If you ever, some people may have this kind of experience. You go out and talk to a bunch of potential funders, and a bunch of them will say, "Okay, I'll fund if I'll put in X if you'll go and find somebody else with Y," and so you get a lot of kind of chicken and egg games going. So the lead investor solves the chicken and egg game by saying, I like your project, I like you as a founder, I'm ready to invest, and then goes out and helps you bring in other co-investors around the edge. Once you get this investor kind of lead investor, you're really halfway there to a full funding round. Sometimes, of course, you might only have one investor, and you only might need one investor if they have enough capital to put in. But I would say the majority of early stage rounds, whether they're hundreds of thousands pre-seed or whether they're 10 million kind of Series A or seed, a late seed, they generally have a lead investor and others come in around it. Generally, they need to be ready to invest at least 25 and maybe better 15% of the total amount of capital. There are exceptions. Sometimes a lead investor might not have a lot of money to invest, but just put a little bit in. But if they're thought leaders in the space and they're charismatic in the sense where they can help you convince other investors to bring in, often it really makes sense to bring a smaller investor in and work with them to find larger investments. In Finland's rule of thumb is at seed stage, we're talking about less than 1 million euro needs, and then early stage is kind of between 1 and 5 million. These numbers are all over the place, so I'm not going to really focus on them. But the only point is, if you can use platforms like Venture Deals, like Crunchbase, free, and then also their paid resources like CB Insights, PitchBook, where you can actually really segment investors well. So you say, if you do a study, if you kind of do a business plan and say, I need 2.5 million euros now, you can go out and you can identify the 50, 100, probably 100 investors in Europe that will do that scale of an investment. So using tools like that, you'll be able to kind of identify whether within that investor segment, whether it's VC or angel, how much is this investor typically looking for? And usually, this is about an individual. So, a lot of people talking, I'm just with one project now where we're raising money, and the founder keeps talking about great funds, and I keep kind of reminding him that, to bring money in, it's more about convincing an individual within a fund and giving that person the tools to go around and convince everybody else. So a good solid pitch deck, maybe a one-pager that describes your project and startup, and make sure that you kind of, when you get that lead investor, you give them the tools to go out and actually raise the money for you. It's a great video. I will just forward this later, but it's how to distinguish a lead investor and a follower. Because again, it's super important not to waste a huge amount of time on followers in the beginning, until you can get that lead investor. So that's kind of that piece. Then I want to Now I want to jump over and talk to you a little bit about a little bit. So first of all, any reflections or anything that somebody would like to ask or comment on at this point? Good. Let's so now I'm going to go and talk to you a little bit. I'm not going to go through my whole valuation talk here, but I want to go through how valuations happen. So let me do this. So valuations. So to the earlier point, who was it made it? Alon made it. What does post-money imply? What does a post-money valuation imply? I mean, what a post-money valuation is really, it's the value of the company after the money's on the table. And the way to think about this is, the more money you bring in, the more your post-money is going to be, and possibly the more your pre-money is going to be. Because again, think about that company I showed before. If they'd gotten 50,000 in, they're not really, they have some assets, they have some research, they have some algorithms, and then they get 50,000 on top of it. Well, you know, you might be able to maintain a team of 2 or 3 for, you know, what, 3 or 4 months. So you can't really develop it very far. And so that makes sense that it's a lower valuation, that the intrinsic value of that kind of work product that you have is 200,000. On the other hand, if you get $1 million in, then you can do something, right? So then you can maybe hire 5, 6, 7 people and operate it for a year. And then you can actually push that, you know, push your core kind of intrinsic value of your company, whether it's mechanics, whether it's digital, whether it's services, whatever, you can really push it forward. So to me, that the difference between, you know, there's a huge difference, 20 times difference between the Finnish investor and this Danish investor in the US. Well, that makes sense because, you know, with $1 million you can, or euros, you can build something a lot faster and bigger. So I always have to remind people that, you know, sometimes it's actually better to raise more money than less. And as you'll see in a minute, kind of investors have sweet spots. And, you know, you might say, if you go out with a mentality to say, well, you know, I only need 50,000 to get a little bit done, you're in general going to get a fairly low value. You know, you're going to give up a larger percentage of your company for that small amount. Then, for example, if you went out and tried to get $1 million and said, okay, we're going to build a team with this, and we're going to try to capture more markets and, you know, grow faster and whatever. So always keep that in mind, that you know, stay ambitious with let your fundraising match the ambition of your basic project. Don't try to piecemeal it, but try to build a longer term plan and raise a little bit more money. Valuations happen in a marketplace. So, you know, again, if you look at valuations in the US versus Finland, I've looked at that a lot. The valuations, if I compare a typical seed, really pre-seed round of a company with a good demo or a good kind of beta version and a good deck and a good idea of what the business model is. The average valuation here is about €1 million. This is a huge rule of thumb, but if you look at all the investments done in Finland by angel investors, about €1 million. Take that same package over to the US. In Silicon Valley, the median, generally you're talking about, actually the million I just said was a median, not an average. In the US, the median is going to be, for that same thing, it's going to be between 3 and 7 million. So to exactly the point I made, you've got a bigger, you know, you've got more capital there, and you've got more people thinking about, you know, your market. But the flip side of that is the probability of raising money is probably lower in the US than in Europe. So while if you try to focus on the US, great, you're probably going to get a better valuation if you get funded, but you may do a lot of work and not get funded. The best architecture for an early stage funding round, in my opinion, is a local investor, someone that's close to where you're setting up the company, and then a kind of global investor who's closer to the markets that you're ultimately trying to get to. And when you're setting up your company, think about that, because a lot of, I, for example, I have a portfolio of 10 companies in Belarus. Don't ask me why. It was kind of a crazy place to do it, but I'm glad I did it now, because when we made the investments, we actually had the team set up the companies so several of them are in Estonia, several of them are in the US, actually most of them are in the US, one in Netherlands. But anyway, we got the companies set up in markets that are trusted by investors. The founders were in Belarus. They've now most of them have moved. But just remember that you're not subject to just founding the company in your area. And I really advise you to think about, as early as you can, get at least an entity, either a parent company or a subsidiary in the markets where you're actually trying to access. So just saying that depending on where you are, again, the same product, the same service, the same team, the valuations vary widely. So getting back to Alan's point, what does a post-money valuation really mean? It's really, at the end of the day, it's what the investor was, the amount of money that the investor was willing to invest, and divided by the percentage of the company that you as the entrepreneur were willing to share. So it's basically, it's not a function of a mathematical formula, really. It's really a negotiation process. And so in that sense, a lot of the kind of math is artifacts. This is exactly the same thing I showed earlier. I'm not going to talk about these methods. There are a bunch of fancy methods that you can use to try to value companies. They don't work with startups. I just wanted to show you the few methodologies that there are. And I know, again, as many of you being scientists, you're going to think that this is incredibly basic and almost a silly way of doing it. But this is really this is how sophisticated investors are in the beginning. They're trying to. So they're basically 4 methodologies I'll show you. So the first one is basically, and Dave Berkus is a famous investor from Silicon Valley. His algorithm, we saw Tim Draper's a little bit. Dave's algorithm is, okay, he wants to look at the idea, the prototype, the team, the board, the existing board of directors, the advisors, whatever, and whether the company has initial sales. And he basically arbitrarily, if kind of looks at almost a 0-1 for these, has a willingness to pay a valuation of up to 2.5 million. He may kind of say 1/2 for this or 1/2 for this, but he's basically just looking at different elements of the value of the startup, and assessing, arbitrarily putting a value to it, and then of course doing a lot of work to figure out, is this a sound idea? Is the prototype a good one? Is the team good, etc. So I'm not saying that not an incredibly sophisticated investor from the fact of the work he does to validate the stuff, but the mechanism to him is not that important, because at the end of the day, it's going to be a negotiation, right? He may come up with an idea of what the valuation is. It's only going to be kind of consummated when you agree to take money at that rate. Second, slightly more sophisticated, and this is getting to a more sophisticated investor brain. So this Bill Payne scorecard looks at the management, the market size, the product, the go-to-market strategy, the stage of the company, and then kind of intangibles, and creates a weighting. So in this case, like I said, when we looked at Tim Draper, that drawing kind of was, again, it was kind of linear. It just went through a kind of a set of factors. This one is nonlinear in the sense that management to him is 30% of the valuation puzzle. The market size is 25%. Product is 10, go to market, et cetera, et cetera. And then he goes in and looks at the company, does, again, a good due diligence, and puts some sort of a rating next to each one. And then some commentary here again, key hires presence could be huge. You know, in general, there's research behind that. And he simply does a weighted average. So he takes the weight he sees for that attribute, multiplies it by a kind of a index, and comes up with a, and then says that the average the normal company I'm looking at in this sector, in this geography, is worth about, with no revenue, is worth about 1.75 million. Well, I like this company a little bit better than average because, you know, primarily these factors, the management was great. The prototype he found worked well. So he kind of waited and says, okay, I'm ready to pay 1.9 million. And what happens after that, of course, is he goes and he says, okay, talk to the entrepreneur, and say, I think you're worth 1.9 million. And, you know, I'm willing to put 200,000 euros in it, or $200,000. And you go out and work that out. So it would be $200,000 divided by 2.1, right? Because you've got 1.9 million plus 200,000. So 2 divided by 2.1, or 200K divided by 2.1 million. Not sure what that is, but it's around, I guess, a little under 10%. So that's kind of where that negotiation goes. But again, I always call it, this is the brain of the investor. Every investor is looking at a different set of factors and has a different set of weights to put to it. So Tim Draper would have put probably market size as 50%, and then management is 25% if you try to kind of shoehorn him into this model. This, I'm going to show a couple others. This just gets a little bit more sophisticated over time. They look at more factors here in the so-called risk factor summation method, but it's again very similar in the sense that they figure out what each component might be worth. They figure out, you know, how good the company is on that. They add it up. They come up with a valuation. And then the last one that's actually the most sophisticated, but almost the most useless in my opinion, is the so-called venture capital method that's based on a required rate of return. So try to follow me on this, because this, I think it does. I think it's useless, but it's insightful to what value really is. And I am cognizant we have 10 more minutes, so I'll have a couple more slides after this, and then let's have a little discussion. The investment is $1 million. The exit year, so I'm getting ready to make an investment, and I'm going to build out what these factors are. I'm ready to invest $1 million. I believe that we can sell your company in 5 years. So I look at your technology kind of readiness. I look at the market that you're going into, and, you know, kind of put my finger in the wind, and I say, looks like about 5 years to sell the company. I think that in 5 years, you can do $20 million of revenue. What's this based on? Well, this is based on kind of my insight, but you've built a deck, and you'll learn some about this in the program. You've built some forecasts. You've probably told me that you're going to be doing $100 million in year 5, but I'm going to put some sort of a haircut on that and say, well, I think your numbers are a little bit extreme. I think 20 million makes sense. I think you can do a 10% net profit. So I think you can do 2 million of profits. I look at your industry, I open up the internet or the newspaper, whatever, and typically a company in your industry is trading on the stock market about 15 times revenue. So you know, based on all these kind of assumptions, I can say, okay, 2 million of revenue, sorry, 2 million of profit times 15 gives me a company value of 30. I need 10 times my money back. So like Tim said, or no, George said, you know, my number is 10x. I want 10 times my money back. And the reason I want 10 times my money back is because I'm creating a portfolio. I'm going to invest in a number of companies. So I need you to be a star, and I need you to return 10 times the money, because I know that for every star I invest in, there are 3 or 4 dogs that I'm going to lose everything. So it's not saying that, you know, if I put $1 million in, I wouldn't be satisfied in 5 years to get 5 million back. That's 5 times my money, right? That's not a bad exit in any market. But if I'm standing here in day 1 I need to look for stars that are really going to take off and return at least 10 times money. So here I'm saying that I think your company value is going to be 30 million at the end. I need 10 times my money back. So my required valuation, post-money valuation of you now is $3 million. I'm going to put in that 1 million. So that post-money of 3 million is going to, I'm going to basically take the 1 million I put in and divide by 3 million to get 33% of your company. Pre-money will be 2 million. So that again gets me back to thinking, okay, I'll go and talk to you and I say, well, I ran my model. I think you're worth 2 million. You're going to come to me and say, well, you know, I've got other offers at 4 million valuation or something. And then we're going to have a debate and see if we can come to an agreement. But that's the kind of first cut. In my opinion, all of these are terrible methodologies, meaning they're insightful, they make me learn something, but they're not sufficient. So I'm going to get my last actually point here is going to be the valuation model that I use. And I'm going to, you don't need to know all this stuff, but I want to show you when you see the matrix, I hope a light will come on. No, it's not that. It is, where is it? Yes, here. So this is, I think this is the most sophisticated and the best way to look at company value. I looked at three things. So the way to look at this is there are three categories of factors I want to look at. I want to look at what's the current deal environment.
Will, at this point, we're seeing your slides still.
Yeah, you are seeing my. Oh.
Yeah, the venture capital one. Yeah.
Oh, weird. How about now?
I was seeing the table, exit realities, financing realities,
yes,
and current deal environment.
Oh, okay, great. Then maybe it's a lag on my part. Sorry.
Yeah, all right, sorry. But so you got the current deal environment and you got basically 13 factors. So you look down here and say, okay, how's the quality of the pitch? Is it, you know, is these guys really thought through their message to investors? Is the founder credible? How complete is the product? How ready is the market for your product, et cetera, et cetera. So I'm going to look at all of these, and basically the way I do it and my team does it is we basically rate these 1 to 10. So 10 being, you know, if it's a perfect pitch, it gets a 10. If it's a terrible pitch, it gets a 1. So we basically, over time, we rate all of these things about the current environment. Then we look at the financing requirements. So how much money are you going to need over the next, until you exit? So that's why I said it's not only about how much you need now, it's how much money do you need until you exit. And then if you look at things like the margin level in your business model, how fast your kind of cash conversion and sales cycles are there possibilities that, you know, is it a hot market where investors are out there that might be willing to buy you early? Things like this will kind of give an indication. Do you need a lot of money in the near term, or you do need a little? And the less you need, the better for me, because if I put money in now, I'm not going to get diluted with future investors because you don't need them. And then, by the way, in the scientific areas, grants and non-dilutive funding are huge. So can I put in $1 million now, and can we go to the EU and can you get an $8 million, $5 million grant, and can we get this thing into market with, to Sarah's point, with non-dilutive funding? And then the final thing is the exit realities. How big is the market? So absolutely huge. It is. How big is the market going to be in 5 years when we're going to sell this? If it's going to be huge, that means it's a chance for a great exit, and there'll be a lot of buying going on. So I think this is an evolution. I'll put in the Greta, I'll share this folder, and it has these tools, but I will give you a hint that and I'll have the link there. Sarah is a great set of tools for entrepreneurs to learn about how investors think about startups. And it has in there, it has this model, and we've adapted a little bit for our case. But what we do is each one of my 5 senior partners, we all independently rate companies. When you set us a deck, we all independently rate them. We put those ratings together, and we compare all the different companies we look at in a given week, and we take the top 2 or 3, generally in our case, we see about 40 to 50 cases a week. No, not that many, 25 to 30 cases a week. So we'll generally kind of look at what are the 3 or 4 or 5 best by this criterion, just by simply doing a simple average of the factors. And that will lead us to say, okay, let's pick up the conversation, start discussions. So that's kind of my the sum total of this is that this is again another look at an investor's brain. And I think this is a prevailing way to do it because every investor is facing the same thing, the realities of the current market, how much money you're going to need over time, and the exit realities. So if you think about pitching, when you're pitching, you don't have to tick all these boxes when you do a pitch for investors, but find the ones that are your best. What is it that serves you best? Where are your, which are the factors that you're strongest in? And that's what I'm going to put in my pitch. I'm really going to focus my pitch deck on that. I'll put all the kind of expected things in there. But if you're, if you've got a complete product and some real sales traction, I'm really focusing on that. If you've got access to, a line of grants and non-dilutive funding, I'm going to highlight that. It's because again, in the beginning, it's about getting the investor, kind of getting a synapse to kind of fire in his brain to say, okay, this is the company I want to go after. So that's more or less my talk. The last thing I'll just kind of end with is I think, first of all, when you're fundraising, you need to be prepared for anything, anytime. So that big investor or that perfect investor may come any day, any place. You always need to be ready to give your, quick story and try to engage. I do recommend, these are the things that I look for, kind of urge you to create. Everybody has slightly different view on this. I really like companies that have a 1-page or a 10-page deck, which is kind of simple, relatively simple and easy to read through. Ultimately, if you're raising significant amounts of money, which I'd say, in the millions, then you need some sort of a kind of a longer business plan or operating plan. You need some financial forecasts. You need a plan for how you're going to spend the money, super important. If you're going to raise $1 million, you need to tell, okay, we're going to do it for hiring marketing, marketing people, entering 3 new markets, whatever it is, but tell us how you're going to spend the money. Then you should kind of yourself be preparing who are some target investors that I'm going to go after. So that's something that you should prep. And then finally, this is gold. So can you find customers or partners or collaborators, whatever, kind of well-known people in the industry that'll stand up and say that your innovation is going to be one of the top ones coming out. And then, and because that at the end of the day will happen. At the end of the day, investors can put money, they want to talk to people independently that know you, know your idea, and can help them report. All right. So yes, so great. There are a couple, last question from Greta. So is it possible to ascertain investors' weightings by their history of investments? Great question. And the answer is you can. So if you can get access to enough of their track record from Crunchbase and other places, I think you can kind of ascertain that. But on the other hand, there's the argument to say that investors are always looking for something new, right? So if you only go on what they've done in the past, they may be looking for the next big thing. So, but to large scale, if you go to Crunchbase, you'll be able to figure out the size of rounds that investors typically invest in. You get some general idea about the valuations, but a lot of this stuff is very, it's very tough. It's Jonathan. Okay. It's tough to get that data, but on the good side, you can just ask. And then I do have some resources. Again, I'm going over time, but I can share with you. There's a really good resource European-wide, of basically it's a Google sheet with where every investor has updated what they're looking for in an investment, every fund at least. And that's good. That came during COVID. And I think, I'm not sure if it was an EU project or who put this together, but it's a very nice resource because it obviously now a lot of companies need to raise money without actually physically getting in front of the investor. So this list really gave some good insight to there. So I'll include that as well. I'll stop talking. Hey, pleasure to talk to you guys, and I'll definitely stay around for questions if anybody wants, or happy if you want to come back to me by email, whatever.
Yeah, I think we can keep this session open, but I will stop recording. And just for everyone who needs to leave, thank you for participating. And from my side, a huge thanks to Will. As I mentioned, that there will be a follow-up email with many resources coming up, and as well as a recording of this webinar. So for everyone who needs to run, thank you for being here. And if there are any questions, then
Around, thanks.
this is the time.